This is the most consequential video in the module because the wrong entry here does not just create a bookkeeping problem, it changes the picture on the tax return, and in some cases changes how much tax you actually owe by thousands of dollars. The mechanics of paying yourself are different for a sole proprietor or single-member LLC than they are for an S-corp owner-employee. Get the entry wrong in either direction, and you've either overpaid tax for no reason or underpaid in a way the IRS can recharacterize with penalties. Today is mechanics, not strategy, and the boundary matters. Module 11 covers how much to pay yourself, reasonable salary methodology, quarterly estimated taxes, the self-employment tax math, the smoothing rhythm that makes founder cash flow predictable. This video covers the entry, the bookkeeping line, the classification on the chart of accounts. The reason the split between mechanics and strategy is enforced this hard is that getting the mechanics right is independent of how much you pay yourself. Same entry whether the draw is $2,000 or $20,000. And the wrong entry costs the same either way. For a sole proprietor or single-member LLC, the rule is simple. No W-2, no payroll, no salary to yourself. The IRS does not recognize you as an employee of your own disregarded entity. Compensation is an owner's draw, which is money transferred from the business checking account to your personal account. The bookkeeping entry is debit owner's draw, which is an equity account, not an expense account, credit cash. Owner's draw lives on the balance sheet under equity alongside owner's contribution and retained earnings. It is never on the profit and loss statement as an expense. The reason this matters is that the draw does not change your taxable income, and people get confused on this almost universally. Taxable income for a sole proprietor is Schedule C net profit, revenue minus expenses, period. Drawing $0 from the business does not lower the tax bill by a single dollar. Drawing everything you earned does not raise it by a single dollar. The tax is on profit. The draw is just the timing of money movement from the business account to your personal account. If the business profit was $80,000 and you only drew $30,000, the tax is still on $80,000 and the other $50,000 sits in business retained earnings. The common error is booking the draw as a business expense, and it's the error I see most often when I audit a sole prop's books. Salary expense, wage expense, owner compensation expense, contractor expense, any expense category. The effect is the same. Reported net income on the profit and loss statement is reduced by the amount of the draw. Schedule C profit is reduced. Self-employment income is reduced. Income tax owed is reduced. The IRS or a CPA catches it, the entries reverse, the profit restores, the tax becomes due, and depending on the year and the amount, penalties may apply. The fix forward is the same every time. Reclassify to owner's draw equity, restate the year if needed. The S-corp case is structurally different because the S-corp is a separate legal entity and you are both its owner and its employee. Pay yourself a salary as a W-2 wage, processed through payroll with the full machinery, federal income tax withholding, state income tax withholding, Social Security, Medicare on both the employer and employee sides. The IRS requires a reasonable salary before any distributions are taken, and the reasonable salary standard gets covered strategically in Module 11.2. The bookkeeping entry for salary is debit salary expense, credit cash, with the payroll tax entries running alongside through whatever payroll service you use. Salary and distribution are two different flows out of the S-corp, and the tax treatment of each is what makes the entity election useful in the first place. W-2 salary, debit salary expense, credit cash, taxed as ordinary income with Social Security and Medicare on top. Shareholder distribution, debit shareholder distribution, credit cash, taxed as ordinary income only, no Social Security, no Medicare. The distribution is an equity entry, not a compensation entry, and it flows through to the shareholder as K-1 income. The salary piece pays payroll taxes. The distribution piece does not. That gap is the entire economic point of S-corp election for a coach earning above a certain threshold. The split between salary and distribution determines how much of your income hits Social Security and Medicare, which is roughly 15% on the salary piece up to the wage base. Mislabel salary as distribution. The IRS may recharacterize on audit, add back the employment taxes, assess interest and penalties on the recharacterized wages. Mislabel distribution as salary. You overpaid payroll taxes by 15% of the misclassified amount. No refund mechanism. The money is just gone. Entry discipline matters in both directions, which is why the bookkeeping software has both accounts available, and the chart of accounts in Module 7 already had them set up. 3 mistakes show up repeatedly in audits, and naming them helps you not make them. 1. Sole prop treats draw as a business expense and incorrectly lowers profit. 2. S-corp owner takes only distributions with no salary at all, which is the textbook recharacterization risk covered in Module 11.2. 3. S-corp owner pays all earnings as salary with no distribution, which wastes the self-employment tax advantage that was the whole point of the S-corp election. The first one is a mechanics error. The second and third are strategy errors with mechanics consequences. Module 11 handles the strategy. Today's video is just to keep the entries clean. 2 coaches, 80,000 of net income each, different entities, different mechanics, same outcome on the books. Sole prop, 4,000 a month in draws to personal checking. Entry each time is debit owner's draw, credit cash. Schedule C at year end shows 80,000 profit. Self-employment tax on 80,000, correct. S-corp, 50,000 in salary through payroll across the year, 30,000 in distributions taken across the year. W-2 shows 50,000 of wages with payroll taxes assessed on 50,000. K-1 shows 30,000 of distribution income with no self-employment tax on the 30,000. The advantage exists only because the salary entry and the distribution entry were done separately and correctly. Same 80,000, different tax outcome. Module 11 covers when this trade-off is worth the S-corp election cost. Before the next video, pull the last 6 months of compensation entries in your bookkeeping software and audit them. Sole prop or single member LLC. Search for salary expense, wage expense, and compensation accounts. If any line items there belong to owner draws, reclassify them to owner's draw equity now. S-corp. Confirm payroll has been running since your election date, every cycle on schedule, and confirm distributions are entered as shareholder distribution equity rather than as salary expense. Find a miscategorization, flag it for your CPA before year end. Mid-year corrections cost a few $100s in CPA time. April corrections cost 5 times that and a different conversation.